Hello and welcome everyone to the iOS 101 webinar. This is the pre-conference conversation that we are having to get us all primed and ready for the main event happening next week, the inaugural Industrial Outdoor Storage Forum happening Thursday, September 5th in Long Beach. My name is Nicole Rupersberg. I am the producer of the iOS Forum, and my company, Information Management Network, or IMN, has been producing B2B real estate conferences for the last 30 years. We have 50 events on the schedule for this year alone, with even more in the works for next year. So we are always looking to grow and expand our reach. And because of that, we are always paying attention to the biggest trends and emerging sectors in real estate. And obviously, one of those big emerging sectors of the past few years has been industrial outdoor storage, which is why we are all here today. So this webinar is designed to be a sort of crash course overview of everything you need to know about investing, owning, and operating in the iOS space, at least as much as we can cover in an hour. So for those of you who are new to this space, or maybe, just starting to dabble, or just iOS curious, this will provide something of a baseline of knowledge for you to get started, especially as we go to the event next week, where we're going to have much more nuanced and in-depth conversations with some of the biggest names and biggest players and brightest minds in the iOS space, some of whom have joined us here today for this discussion. So I will close by saying that there is still time to register for the iOS Forum next week. I will make sure that we drop the link to that in the comments section. Also, for any questions that you have for these guys, they are here to share their expertise. They're eager to answer your questions and happy to. So please take advantage of their knowledge here while you have them. So drop any questions you have in the chat box so that they can get to them as they're able to. And without further ado, I'm going to hand things off to the moderator with the most, Justin Horowitz. He's a legend in this space. So Justin, take it away.
I appreciate that, but the people around me make me a legend. So it's all thanks to everybody else here. So I appreciate, Nicole, everything you've done to get the word out in the space. It's been a little while, and you've been planning this for quite some time. So thanks to everything you're doing, and it's going to be pretty awesome next week. Have everybody on the West Coast. They say it's the West Coast as the best coast. I'm an East Coaster, so we'll see when we get out there. But yeah, Nicole, that's really awesome. Thanks for doing this. It's going to be some amazing people out there next week. I'm Justin Horowitz. I've been doing a few of these panels now. So work at Cooper Horowitz, debt and equity platform. My grandfather started 60 years ago, and I've been specializing in iOS over the past few years. It has some really cool people on this panel. I'll kick it off to Dan, then we'll get the rest of the folks going, and we'll get this started.
Yeah. Hey, I'm Dan Flamholtz with Greenspring Realty Partners. It definitely goes without saying, thanks to Nicole and her team for putting on this and all the work that they've done leading up to next week as well. I know a lot of behind the scenes action has taken place, and super grateful for all of her work and the team's work. And yeah, so I again run Greenspring Realty Partners. We are a heavy industrial focused investment company with sort of a specialty in the iOS ISF world. We're fortunate to start acquiring what we were just calling, sort of tough, heavy industrial properties about 10 years ago, and then have been fortunate enough to sort of participate in this boom that occurred at the beginning of the pandemic and has been running ever since. So excited to be here and look forward to a great conversation today.
Appreciate it, Dan. Speaking of legends, we got Matt Hunsucker. Love to hear what you're up to, and then we'll follow up with Ned.
I don't know about legend, maybe the court jester of the group, but I'm the founder of iOS List. So I came later to the party than Dan and Ned. They've been at it for a while, but I started getting into the space in 2020, 2021 as it was heating up, and I realized how much institutional capital was flowing in, and I came across a few parcels that were suitable for iOS. But I found as I was underwriting them, there was little to no data. So I did what anyone would do. You start calling around brokers, tenants, try to figure out the space yourself. And I was dissatisfied with the information and the media that was out there for such a large space. So I decided to create that media and data arm. So I founded iOS List which is basically an email newsletter. It's free. You get 3 times a week, and we cover all the acquisitions that happen in the space, all the capital raising, all the leases that are signed. And on the back end, we've got a pretty robust data set of rent comps and sales comps. So you can think of it as an unbundled CoStar that's curated only for iOS properties.
You didn't mention the weekender though. You have us all
And there's
cracking
a
up at Saturday mornings.
Yes, we put out a weekend edition that we have some fun with. So it's the dessert for sitting through the rest of the week.
Well, appreciate that. I know you're the keynote speaker next week, so really excited to hear your thoughts and kick it off next week. And then Ned, love to hear from you.
Thank you for having me here, Nicole, IMN team. Thanks for putting this together. A great event. I'm looking forward to it. The name of my company is 9606 Capital. I'm the CEO. We are an operator in the industry, meaning we're vertically integrated from sourcing properties, acquiring them, property management, construction management, and leasing as well. We also have our own capital markets team in-house. We do use guys like Justin as well, because he's got more resources than us. Been in the industry for about 10 years and loving every minute of it.
Yeah, this has been an incredible, half decade for me, and obviously Dan, Ned, Matt longer as well, and a lot of people that are going to be at the panel next week. I mean, it's pretty cool how long this has been going on, and obviously this little acronym that we came up with, whether it's iOS, ISF, I've heard of iOS. We're getting a few letters out there, so it's pretty cool to see what this has grown into, and it wouldn't happen without you guys. So I appreciate it. I think we can kick this off. Just again, it's a one-on-one. Would love to hear the basics. In your words, tell us a little bit about iOS. What does that mean to you? What does it mean to all of us that we kind of love here? Dan, you want to kick it off?
Yeah, I mean, so I think the iOS terminology has certainly evolved. When we first started hearing about iOS, everybody sort of was scratching their heads and not really understanding what the asset class truly is. And as it's evolved, it's sort of become very, very well known that while it's sort of the new darling asset class, it's also can be very tough and difficult to actually truly understand, as Matt said, because it is such a new asset class, right? So when we speak, bare bones, what iOS is, right? It's industrial outdoor storage. It's an industrial property with or without a building that can be used for outside storage. And we could get into serious discussions about, well, if his property is zoned industrial and it can be used for outside storage, how come you go and try and get a new use and occupancy permit and you're turned down for the use and occupancy permit because they won't allow outside storage? That's again a whole other separate topic. But I think the pandemic really spurred this boom of a new asset class. It has been institutionalized. I know that a lot of groups are talking right now about, is it truly institutionalized? I think just based on the amount of capital that has come into this space and the type of investors that are out there, it is institutionalized. And while you don't have these mega portfolios yet, I mean, I every time I'm talking to anybody, I'll point to the Altera guys and what they've been able to do with so much capital and the aggressive buying spree that they've been able to go on. But it's so detailed. It's such a great approach, and they've built a phenomenal portfolio. Which again, and not just them, right? There's many groups that are sort of right with them, but that's a very institutional approach to growing a portfolio, not doing one-off deals, being very market focused, and hitting great numbers also.
Yeah, I mean, Pfeiffer even said a few weeks ago in Atlanta that it's a $200 billion to potentially $400 billion industry. That the numbers are there, and it absolutely is institutionalizing. And I think the days of trying to educate, and we talk about lenders and equity partners and educating them on what is iOS, and I think that day is over. I think people get it at this point. How about you, Ned?
So Dan covered a lot of it. I'll just kind of expand on it a bit. I enjoy iOS for some selfish reasons, meaning it's very low CapEx, so it's easy to manage it. When you're re-renting the property, we also own industrial properties. You don't have to put large amount of CapEx, into a building or a new roof or, redoing it for the tenant. So from that perspective, also the fact that you can still buy industrial properties, they're very hard to acquire, meaning the zoning is very difficult. You can still find supply and you can get current cash on your properties, which is not the case in a lot of asset classes. They have a good, demand on them, like multifamily. It's very, very difficult to see current cash on a good product. So what I'm seeing this asset class institutionalize. We were in self-storage. I still own some assets. And we saw this happening in self-storage. When I first got involved in it, it was like 92% fragmented. It's probably about, down to 40% today, 40 or 45%. So I see the same things happening, more institutional money coming in, the values are going up. And one thing that really drives it in iOS is that it's nearly impossible to go to a good city and take a piece of land and develop an iOS property. So you have this limited supply and increasing demand that's driven mostly, in my opinion, by growth of e-commerce and also some onshoring of manufacturers back to the United States. So I believe we're going to see this trend going for the next 10 or 15 years, and it's great to be here.
Matt, what gets you excited about iOS?
I think within the space, piggybacking on what these guys said, iOS sounds simple, industrial outdoor storage. But underneath that umbrella, there are 31 flavors of iOS properties. So you've got port adjacent container storage. You've got construction laydown yards. You've got logistics adjacent, transloading and truck terminal facilities. So juggling the various uses and the proper uses for every site and every market location is a very interesting puzzle for operators to figure out in the space. So there's no one size fits all. As Dan said, you can be zoned heavy industrial all day, but if the municipality won't let you park trucks there or operate at a certain volume or do a short-term overnight parking, you could have issues. So digging into that and really understanding the lay of the land locally, it's very much a local game.
Yeah, I like exactly what you just said makes me want to run through a brick wall for this space, is that it's so different. Like it's you think about 0 lot percent coverage versus 10% lot coverage, and our lender is going to appreciate that you just have a piece of land, but then you realize, well, you've got $1 billion corporation leasing it with 3% bumps. And so I think those days are, we think about the growth and the maturation of the space, and that's changed. 4 or 5 years ago, you have a piece of land, and that's a covered land player. That's a piece of land. Now there's lenders with appraisal departments specifically dedicated to iOS, and so just talking about what it means to us and the maturity process of it, I think that's super exciting.
I think it's really interesting, just like given the overall market dynamics of other asset classes right now, right? Like office is a bad word, right? Like nobody wants to talk about office. And we've seen a shift from office REITs, right? Not a family office, not a small office investor, but massive companies who now are overnight saying, well, we're now going to get into iOS, right? They people feel like this is a sort of an easy cakewalk asset class. And I think that's where, right, it's been really interesting to see the evolution over a very short amount of time, because you still have people, again, who right, now I totally agree, right, low CapEx, but right, there's so many things that go into it that besides the CapEx, right? Like, did you check the box on zoning? Oh, we're buying, I literally had a conversation with somebody who's on this call right now, probably 45 minutes ago, who's a very seasoned broker, very seasoned, did not know what the word impervious meant. So when we started talking about impervious area of a yard space, right, no idea. So how are you valuing the property? Well, it's 5 acres. Okay, well, what's the impervious area, right? What can I put to your point, Matt, a container down on, a trailer on, a piece of construction equipment rental, supply yard, whatever it may be. Well, the whole thing, you can't put it on grass, right? You can't put it on, something that it's going to trigger 19 different zoning violations from the municipality, and you're going to be you're going to be shut down. And again, this is a tremendously successful broker within the space. So when you're having those types of conversations, it shows the the infancy of the asset class. It also shows, right, that I think people can be very successful in this asset class without the intimate detailed knowledge, but also the fact that, right, there's a lot of green in this asset class, not, obviously a lot of money green, but also just a lot of people who are in this asset class because, right, it was, sort of the sexy darling of the pandemic. A lot of people shifted into it. It's brought a tremendous amount of capital into this space, which has been fantastic. But with that, it's been very interesting to see some of the buys that have occurred, through, right, the sort of, to Matt's fantastic idea, right, lack of industry knowledge and lack of comps. Again, same conversation. I literally said I'm not a huge golfer, but I can hosel rocket a couple balls, into some, lakes here and there. And I said, you sort of like lick your finger and put it up. It's like, okay, as the wind shifts, it could be 4,500 an acre per month, or 7,500 an acre per month, or 2,500 an acre per month. And one of the reasons being is because it's not, right, it's so new and it's not truly institutionalized. While there's institutional players in the market, you're still running up against, you're buying a property in, whatever market for $1 million a usable acre, and the folks next door have owned their property for 40 years. They're into it for 100,000 a usable acre. They're happy as can be collecting their $3,000 a month in rent, and you need to try and go get $8,500 a month in rent. There's no difference between the two properties, right? But you just have a much different owner of the property and a much different, trajectory on when that asset was purchased. So one of the things that we do is make sure that when we're acquiring a property in a specific market, that we are looking at, sort of up and down that street, where is everybody else's basis, and trying to determine, are we going to be the high guy in the market? Because you never want to be the high guy in the market, right? Ideally, you're the low guy in the market. Obviously, right now it's very tough to be that way. But it's something that you have to do. Otherwise, you're going to end up buying properties, and your investment's going to fail because, the vacancy that comes up next door, person has no mortgage, right? They're happy as can be doing a below market rent because, like, they don't really know any better, because that's who owns these properties still. So, one of the things I know we've talked a lot about has been, is there runway in the iOS space? And, Ned, to your point, right, I think the next 10 to 15 years, there's tremendous runway in this space, because so far, right, we have a portfolio of about 55 properties. We've purchased from an institution, or a larger group, I'll say, 3 times. Every other property has been mom and pop owned, or a user that wasn't familiar with the space, or somebody who just had to, right, get rid of their property. And so that's the majority of the transactions that are still taking place, right? We're not in the Class A heavy industrial, Class A industrial world where Prologis sells to Blackstone, and Blackstone sells to, this group, and then this group, and they all sort of recycle each other's deals back and forth, right? A deal recently happened in Baltimore, where I'm based, where Prologis, I think it's their 4th time owning the same building over like a 20-year period. That's not happening for a very long time in the iOS space.
Yeah. Mm-hmm. And that's where it's headed, it feels like, right? You go ahead, Ned.
Just to piggyback on what Dan said, in this category or subcategory, the wealth is in the details. If you want to make money, you really have to pay attention to a lot of details. And I can name you about 16, 17 things that we really look at in detail. But the 3 top ones will be the zoning, the environmental, and rents. It's important to know what you're getting into. And what we're seeing in the market is there's a lot of new capital, but there aren't a lot of operators who have been doing this for many years. A lot of new capital, a lot of new guys who have this idea on how it's going to work, and it doesn't always work out for them that way. So, in the past, we never had competition from somebody that was like outbidding us by like 40, 50%. And sometimes now we see that. And then I've actually purchased a couple of those properties back for a discount because they underwrote the rents that were never going to happen. And then after sitting on it for a year or two, they realized, okay, this isn't going to happen. Let's take a loss and move on with it.
Yeah.
So how do you, I don't want to interrupt you, but so for you guys, but how are you looking at some of your underwriting and diligence? Are you going based on brokers? Are you going based on, hey, we have tenants who we have relationships with who are telling us they can pay X amount in a specific market? How are you trying to fine craft your underwriting so that you're not making those same mistakes as you mentioned that some other groups are?
It makes sense. So we have a lot of our own data because we've been buying for the last 10 years, and then we also keep track of data. We are also a very good neighbor. So meaning in any area that we own properties with, we're friendly with the local communities, local charities, we donate. And also we're friendly with the local neighbors. So we'll help them out with property management issues or, get them some LED lights for cheap or, door opener. And we have these conversations with our internal team on the leasing side. So we know what the mom and pops are getting for rents, right? So, we'll try to buy their properties, and then oftentimes we'll partner with them. Like we'll buy a piece of the property and bring in a better tenant that pays a lot more rent if they don't know what they're doing. So, we have that information. We do talk to the brokers, and we find that there's a large gap depending on which broker you're talking to, right? Because they're trying to sell the property. So there's a large gap between what the broker's telling you can get to what you're actually getting in rents. So we typically, if we're talking to new brokers, we try to discount 20, 25%, like right off the bat, first conversation. And then we also have tenants who are telling us what they can pay. But here's the challenge with that. We have tenants in some areas that are overpaying, based on the market rate, but they need that location. But when we underwrite the property, we normalize the rents, right? Meaning we look at it and say, hey, this is what the rents should be, not what they are, what our tenants willing to pay. That's additional cash flow. But if the tenant leaves in 3, 5, 6, 7, 10 years, you're gonna have to release this property. So we use a combination of those things. And then I'm an engineer by education, and we're heavy on software and programming. We have 3 full-time guys on staff. So we program algorithms and we keep really good, track of data. So we have software that spits out like what the rents should be, and it's not on a market by market basis. It's almost like self-storage. It's a 3-mile business. So you got to look at like sub-markets, and then you get to use a little bit of gut, and it's hard to use gut if you've been doing it for a year or two, right?
Yeah. Just to piggyback on what Dan and Ned said, they hit on a couple of very important points. I think one of those is coming into the space, you hear 2 very seasoned operators on this call talking about how important the ground game is.
Yeah.
Having either a large organization or being very focused on one particular or maybe 2 particular large markets or region where you can become an expert, and having that on the ground knowledge really can propel your business and grow your portfolio. Something else on the rent side, a lot of people coming into the space for the first time, they're anchoring on rents they've heard about in the best of times. So during COVID, when there was an acute need for more e-commerce and logistics capacity nationwide, some deals were struck on the rent that might not happen again for a while. But it's important to very carefully underwrite what's going on in the market, be close to the information, and then account, as Ned said, for some sort of discount margin of safety as you look forward. So not to say we'll never get back to those rents again, and also not to say that some tenants might have an acute need for a particular infill asset with a particular set of amenities. They might be willing to overpay because they've got to have it. But I don't think the market as a whole is at a point where they can overpay at the moment for capacity.
Matt, I agree with you there. And I'll just add, depending on who you are, if you're an operator like us that wants to get cash yields and generate a return within 3 to 5, 6 years, you're absolutely right. If you're an allocator that's trying to push capital out, you don't have any of your own money. Like I'm the largest LP in our deals. So in our funds. So if you're an allocator just trying to push capital out and you're getting a salary and an asset management fee, then it doesn't matter so much, right? So it's a different game depending
It
on.
should matter more, right? Because you're dealing with
Yeah.
investor capital as opposed to your own capital. But I mean, I think that's a great point, Ned, right? I mean, you're sort of you're chased to buy.
Well, chase to buy. Look, if like a lot of the, I'm not gonna name names, but some of the new operators are, people that came out of the brokerage world and they got a job working somewhere for 200 grand a year. They're an MD and they're getting a piece of the asset management fee. So the more they buy, the more they make, and they don't have capital in there. So there's a disalignment of interest. Like our investors are very sophisticated, professional investors themselves. So it's I got to work for my money.
Yeah.
There's a ton of smart people in the room and in the space that are, putting good money to work. And, thanks to guys like Matt that just have this, this database that they can rely on too is super helpful and great brokerage, folks in the space. Talking about legends, brokers in the space, Guy actually just asked, Guy Hanaya just asked a question in the Q&A I wanted to ask you guys, which I thought was super interesting, kind of 101. We've all done many deals in the space. What's the most unique use of iOS on a site that you've ever seen? I wanted to do 2 truths and a lie. And I'll start. I've done pipe laydown yards, sites in Nashville that you can have bachelor party tractor trailers on, or porta potties. So I wanted to hear what your thoughts were and which one was the lie.
I have an idea the middle one's a lie, eh?
It is, and I want that to be something so badly. Like I go to Nashville all the time. My brothers lived there for about 15 years, and I see these like massive, tractor trailers for bachelor parties. I'm like, where do those things park? That's probably not what most people are thinking while they're sitting on it and having a few pops. But I'm looking at that thing. I'm like, who's storing those things? So Guy, just to answer that, I love pipe laydown yards. I think they're fascinating. Coming from a world of, New York City office buildings and multifamily throughout the country and all that, I'm like, just seeing a pipe laydown yard with, an NOI greater than, financials greater than what you'd find in another asset class. I think it's so fascinating. And when you start in this space, everyone's like, it's got to be Amazon, U-Haul, Herc Rentals. It has to be. And then you realize there's private equity firms that are backing, these pipe laydown yards or lumber facilities, things like that. It's such a fun business.
Manufacturing raw material storage is theme one, yeah.
Mm-hmm.
That's the truth, I think, right?
That's the truth. Manufacturing raw material storage. What do you call these? Wind turbine engines and transmission storage, and self-storage pods.
Yeah, I like that. Dan,
So
anything that's most unique to without giving away any secret sauce?
Yeah, so we had acquired a property by the Port of Baltimore, and it was adjacent to it's public record. So it was adjacent to National Gypsum. So National Gypsum has 25-30% market share on drywall in North America, and they were bringing down these massive vessels into their berth from Halifax, where they have this huge rock quarry of gypsum down into Baltimore, and we had acquired the property next door to them. They needed to have some extra space for their rock storage. So, they came to us and they were like, hey, we need some extra space. Okay, how much do you need? Well, we need a couple acres. Okay, great. Why do you need a couple acres? They're like, well, we bring, and very, they were totally transparent. They said, we have to bring, our vessels can hold 54,000 tons of gypsum rock. But because we don't have the storage capacity at our yard in Baltimore, we can only bring 27,000 tons down. And we said, okay, well, what's the shipping costs to bring it down? Does it differ? And they're like, no, it differs a little bit because of weight, but it could be about $1 million to get that ship from Halifax down to Baltimore every time. And they were doing 13 or 14 of these runs every year. And we said, so if we can sort of double your capacity, you can bring down a full ship. To us, that probably means you can pay us a really hefty number for 2 acres. And they said, maybe. I mean, so we ended up striking a deal with them for straight rock storage on 2 acres where they could put, their excess material. But for them, I mean, they ended up saving millions of dollars a year to find this extra capacity for their rock. So that was one of those, sort of shake your head and say, okay, got pretty fortunate on this one. But there's many deals in iOS that I think people are shaking their head saying, geez, we're pretty fortunate to do this. I did want to go back briefly. I sort of 2 things. Number one, we talked a lot about zoning, and I think zoning always gets glossed over because people get bored with zoning, and
Yeah.
it's one of those, yeah, no, it's heavy industrial, it's fine. But I think this is one of the times where, when you check the box and you see a property and say, okay, it's got the heavy industrial zoning classification or designation, it's really important as a buyer or a broker or a lender or whoever you may be to actually read what that truly means and understand it from the standpoint of you actually may be able to outposition the market based on your zoning, or you might be in a position where you're outpositioned yourself based on that zoning and the different designations that may be within that zoning. So as an example, we recently acquired a property where heavy industrial zoning. I said, okay, great, it's heavy industrial zoning. It's got to make sense. But when we've done this for a while now, when we know to sort of get into the weeds a little bit more, we realize that under this specific heavy industrial zoning in the specific county, it allows you to stack containers twice as high as any other zoning classification in this county. So when we went to a couple of different users in the market and we said, hey, yes, this property is only 4 usable acres and you might be on 5 or 6 usable acres, but we can actually probably reduce your occupancy costs and you can almost double your container storage on this site. And I mean, we were getting responses like, what are you talking about? How is that possible? And then you actually send the zoning designation. And this isn't going to happen every time, but it's how you can start out positioning yourself as a broker, as an investor in this space when you take that extra step, right? So like, the extra step to glory, I think in iOS is critical, and having an understanding of what you can do to leverage the properties that you are looking at underwriting or acquiring, it might actually set you up so that if a property is on the market, for instance, and you do a little bit of extra diligence or research, you can get that deal because you now understand, what, it's on the market for 3.2, but I'll actually pay 3.4 because I got a little bit more information on it, and I know I'm a little bit smarter than my competition, and I know what I can do on this property that's going to, again, outposition. So it's all about the buy. Obviously, you don't want to overpay, but there are intricacies within this space that I think are much different than the intricacies in other spaces, where if you really understand what to look for, you can be really dangerous in this space.
That's an excellent point. Don't always look horizontal for the acreage, look vertical.
Yeah. So that was one thing, and I think then the other thing, and Ned, this might just be a question for you, but I think Justin, it's also for you as well, is what are the capital stacks looking like in today's market, and have they changed since sort of the inception of the iOS space in 2021? And if they have changed, how have they changed? And also Ned, for you specifically, what's the investor appetite been like now that people are more familiar as this asset class matures?
Justin, you want to go first? I think
you can take it ahead, Ned.
Go ahead, Justin, first. Give us the overview. I'll tell you our position.
Yeah, perfect. So I think, Dan, great question, because again, like several years ago, you bring a property out and there's a handful of lenders and people that say they're in the space, and you have to educate them to now, you go out with a package of 10, 15, 20 properties, and you could have 10 term sheets, and next thing you have pricing that's almost 50 to 75 basis points inside of where you started, pinning each of one of them up to each other. So we've been really successful with anything from deals as small as $1 million on a permanent basis to upwards of 50 and $100 million in the space. But I think recently it's been a lot of I'd say the portfolio loan has been really popular now, where folks have done their business plan, whether they bought cash or put a acquisition financing on it. They've increased their WALT, they've increased the NOI, of course, and we've been able to cash out borrowers. I think in iOS, cold storage and any sort of storage product, we've been able to do some cash out refis. And I think the lenders see there's plenty of NOI that's healthy enough to get over the 120 to 135 debt service coverage, depending on where you are with your credit tenancy. There'll, especially with the wallet that you have in place, whether it's a cross-collateralized loan or a one-off deal. I would say the past several months, it's been a lot of portfolio loans. And so that's anywhere from, $10 to $75 million deals, anywhere from 4 to 20 properties. We're still doing the singles and deals in like the $1 to $10 million range. I think the depth of lenders has increased for that 10 million and up space, because I think it's just, they're not seeing as many office or multifamily or other deals like that. They have to put out bigger chunks of capital to start. And so I think it's gotten very competitive on the bigger asset class for sure. I'd say the $1 to $10 million space for years was really, really active and very busy. It still is. I think we're just getting more term sheets, per deal on a 10, to $75 million basis. And I think and just quickly, the depth of lenders too. Again, these life insurance companies that were never in the space are now calling our phones, and folks we've actually sat in their credit committees with as well, and introduced them iOS many years ago, so that when we did have this 25, 50, whatever the dollar amount may be, package to go to them, we know we're going to get a really attractive spread over the treasury that's very consistent with industrial.
Justin, what are you typically seeing from a proceeds standpoint on bridge loans versus these kind of takeout warehouse facilities?
Yeah, so on the debt fund side and kind of like the bridgier deals, you can get anywhere up to 65% of cost. Some people will go higher. It's just pricing that I don't think is of the appetite for some of the people borrowing today. So I would say 60 to 65% of cost on the bridge side. On the permanent side, you're going up to 60% of cost. You can go higher, but again, then you may get 20 or 25-year RAM versus 25 or 30-year RAM. You may get less IO. I think it all depends on the business plan too. Some life insurance companies historically have yield maintenance or some pretty hefty prepay penalties, where I think now they're seeing, we're still in this 1.0 of iOS, and that's like a huge question I always have is like, what's 2.0? Where are we going next? And I think having a portfolio loan with flexibility on prepay, are you going to prepay the loan the first 12 months? Maybe, maybe not. Maybe you'll do it in 24 or month 30. But you want to have that flexibility, because if, like what Dan said earlier, it goes from like a Prologis, Blackstone, whoever that name may be that buys these portfolios, I think our clients and a lot of folks in the space want to have the flexibility just in case. And I think lenders are okay giving that to them. So life cos have now gotten a little, they've definitely gotten less restrictive on prepay. So maybe half the term is yield maintenance and then the rest is open at par. Maybe that's like a 5 to 10 basis point premium in spread. There's just ways to go around it. I think that prepay is a huge request on a lot of our clients' part, just because we don't know what's going to happen next. We don't know what that optionality is next. I think that's what's so exciting too.
Ned, how are you capitalizing your deals typically?
So I'll try to answer Dan's question and your question. And from what I heard from Justin is like the typical loans out there are like 1.2 to 1.3 DSCR and about 65% loan to value. Is that pretty much kind of went over?
Yeah, I have a deal that I'm working on now in South Florida. One local bank is really excited about it. 5-year deal, a 5-year lease that's on it, 25-year RAM, a year of IO to start, and that's at a 125 debt service coverage. It's by no means institutional, grade credit. It's more of a mom and pop. So we've seen lenders get a little more aggressive on the DSCR. The lowest we've seen is a 1.2, and that's for some of the most institutional grade. And this is for stabilized deals. We've done deals obviously with no debt service coverage, obviously with vacant deals, but they warrant a little bit of a higher rate.
This is great info. So I'll cover your question. I think Dan, when he asked the question, he asked a few questions, which was a little bit about debt and then also about the equity. Is that correct, Dan?
Mm-hmm.
So I'll cover the debt first so we can compare apples to apples. I started buying these many years ago. And when we initially went to the banks, you could educate them all you want, but oftentimes they didn't understand it. And I own other assets as well and have a nice balance sheet personally. So oftentimes in beginning, I would do a personal guarantee on them, right? So that was a way to get the deals done. And typically back then, I would leverage these deals probably 55 to 60% loan to value. And you're buying them at high yields or stabilizing to high yield. So that service coverage ratio was, typically around 1.5, 1.6 just going in. So moving forward now, almost 10 years in, just like you, Justin, we're seeing banks who understand the product. We're seeing, insurance companies that understand the product. What we see with regional banks, we are now mostly taking non-recourse debt. And I would say 95% non-recourse debt. And what I'm seeing with a lot of the regional banks, and this is the case only in the last, I would say 12 to 18 months, they're starting to ask for global cash flow because sometimes the people who are buying it, maybe they're buying a good deal, but maybe they have other bad deals that could put them in default. And I'll tell you something, like about 3 years ago, nobody was asking for it, right? So just to kind of give you an idea on our capital stack, we buy value add properties, meaning we're buying something that's not performing great. We're typically improving the property and improving the tenants. We're putting these things into triple net leases. A lot of the stuff we buy is gross. We're stabilizing to nice yields. We typically put in 40% down payment, meaning 60%, 55, 60% leverage on the purchase. And then once we increase the value, we don't touch it. So we're currently sitting where we have 2 funds, Fund 1, Fund 2, and recently launched Fund 3. We're currently in the fundraising of that fund. We're probably 40% down. We just started recently, and we expect to fill it up by the end of the year. On our Fund 1 and Fund 2, Fund 1 has a DSCR of 2.8, and Fund 2 has a DSCR of 2.2. Our leverage point on Fund 1 is just under 30%, and on Fund 2, just under 35. So we have a lot of free cash. We're making distributions to our investors. The cash distributions on Fund 1 are 27% a year. On Fund 2 now, 3 years in, are 14% a year. So when lenders look at our financials and we send them our global cash flow, they're more than happy to lend us the money. So, probably about a year and a half ago, a lot of lenders were saying, well, we're not doing this now only for their existing clients. And we would say, okay, why don't you look at our financials, and maybe in the future, we can talk about you guys financing us. And then they would go through the financials and they call back and say, well, for you guys, we'll make an exception. And oftentimes even the banks that say, hey, we don't typically do non-recourse, when they see what we have and how we operate it, they're happy to do non-recourse. So, and that's mostly for the fact that we don't leverage a lot. We're thinking about this long term. We don't want to get in a situation where, we lose a few tenants or are in trouble. We've stress tested our properties currently, where we can now, let's say 55, by the way, we have a 99% collections rate. And if we lost 55% of our tenants, we would still stay afloat. So, I've done this for the last, on investment side for the last 25, 26 years. And I've seen ups and downs. So we're kind of slow and steady. And then on the equity side, currently, when we first started, it was like my money and a couple of, previous investors that followed us from self-storage or student housing that knew our track record and were still kind of skeptical about it. To the Fund 2, we are, most of our investors are, sophisticated family offices and some smaller institutions. And now in Fund 3, we're starting to see, medium-sized institutions and some larger multifamily offices, even some international investors as well. So we're starting to see investors that are more institutional. And what helps on our side is that we're an operator. So when they're investing with us on the equity side, we're actually a direct fund, meaning a lot of funds raise capital and they hire operators to go out and buy stuff. So you're paying 2 layers of promote and they're not hands-on. With our fund owns the properties directly, right? So you're a direct owner, you get the diversification. So we're starting to see more sophisticated companies investing with us on the side. And we have audited financial statements. Our previous two funds have produced 31 IRR net of fees and carry. So people are happy. We don't advertise that. When we go out to raise money, we're saying 16 to 18 or, but better to say less and produce more. Yeah. And then finally, for the third stage, for the last maybe year and a half or two, we've been talking to large pension funds and insurance companies who are interested in being the exit for us. So what we're starting to see is pension funds are starting to have allocations for this sub-asset class, yeah, but there are no operators to execute. So they're left with either, and also there are no REITs in this industry, right? So they're left with the choice of either putting money in with an investment advisor where they're going to get double promoted, or they have to find an operator, and there aren't many. So we've been talking to several, and they've been very helpful actually to get us to give us their criteria of like, hey, here's how you should create a portfolio. Here's how to curate it. Here's what we're looking for diversification, not only geographically but also by the industry. So we're building our portfolios and slowly building out an exit possibly to pension fund at the right time.
I had a follow-up question there, Ned, but it sounds like you answered it. I was going to ask about your process for evaluating an exit. Is it portfolio wide, property by property? Sounds like you've got some flexibility and some very large pools of capital chasing what you have. How do you decide when to pull the trigger on that? Does your funds have terms that you got to meet? And Dan, I'd love to hear the answer from you as well. I know you've got a lot of private capital at stake and maybe different dynamics.
So our funds at 10 years with 2 one-year extensions, but we don't plan on sitting on the product that long. And we have sold a small portfolio last year to, I won't disclose it here, but it was a private sale. We sold a smaller portfolio last year to an institutional buyer. The pension funds and insurance companies that we deal with wanted to see an portfolio exit. And we were also doing some small exits along the way just to show the liquidity in the market, because it's something that, makes them feel comfortable. And also when we're making these smaller exits, it helps us gauge where, one thing is going online and looking what the things are trading for, but when you put it on the market and you get the real interest, that's when you really know. And so we exit, small amounts along the way, but the real goal for us is to exit a larger portfolio to a partner that, makes a lot of sense long-term. And maybe, 10 years down the line, or maybe, 5 to 10 years down the line, maybe once the value add opportunity is played out, I don't want to do core plus now, but at some point, it's going to be hard to do value add. We might raise a core plus fund.
Yeah.
So that's kind of, did I answer your question?
Yes, absolutely. Dan, how about you?
Yeah, so we started about 10 years ago, and it's just me and my one partner. So we own all the properties, just the two of us. We don't have any capital partners or investors or a fund, which, for us, right, has really set ourselves apart from a lot of the other groups, because we have no investment committee. So when I'm talking with a seller directly, right, or brokers, that's my biggest thing is we're a deal a day trying to get a transaction done, right? We call ourselves deal junkies, and I know everybody in this space is, but we're able to make decisions very, very quickly, and because we're using our own capital, right? We haven't dropped a contract in a very long time. We're going hard on some of our deals day one when we understand the space, because we've been in the space for so long, so we sort of know what the risks are going into it. So that's how we're going to outposition folks. I think from the debt side, right, because we will typically acquire in cash and then refi out sometime thereafter. It's been amazing initially how many lenders just simply did not understand the space. And Justin, you mentioned earlier, it's like you have a multi-billion-dollar company on a lease, the debt service coverage ratio is like a 5, and they're still scratching their head like, wait a minute, the property's 10 acres, but there's only 20,000 square feet under roof. Like how does that work out? Or hey, right, like what's the we get this from lenders all the time. What are you charging on a price per square foot basis for the building?
Yeah.
and I respond every single time, right? Users that we work with, that we have relationships with, brokers, if they ask that question, I tell them, for a single tenant iOS facility, it's typically gated and fenced. Everything that's within that gate and that fence is yours, and you are going to pay 50,000 a month triple net for it, right? So here it is, take it. There is no breakdown, there's no breakout, there's no price per acre, there's no price per, for the building and for the yard. And we did that really the first time back in 2017, actually with First Transit, which I'm sure everybody on this call knows. And they were like, oh, this is great, because for our contract that we're going to get, we just need to tell them what our annual rent is. Nobody cares what the square footage number is, because we need to know what are we paying per year. We need to know what the nets are. And so they won the contract. They ended up doing this great deal with us. But we really shifted, because initially when we started, we were buying stuff by the Port of Baltimore, for instance, and we were saying it's $5 a square foot for the warehouse. We were not valuing the yard at all.
Yeah.
Not at all. Right. So it was 30,000 square feet on 4 usable acres. And we were saying it's just $5 a square foot for the warehouse. And then, as we got a little bit smarter, and we started understanding, again, this is pre-pandemic, but started understanding, hey, you know what, like for a lot of these companies, the yard is almost more important than the actual warehouse space is. We need to sort of blend this rate. We tried to blend the rate of, you're going to do $5 a square foot for the warehouse and $1,500 an acre for the yard. And that confused me more than anybody else. So I was like, no, you know what? It's this amount per month, triple net. This is the number. We can negotiate that number, right? I'm quoting you 25. You want to be at 24. Okay, that's fine. But it's sort of a all-in approach to the number. And I think now lenders are starting to understand that's really what they need to be looking at, is what is the underlying value of the premises, not the underlying value of the building. And that's a big differential, because in iOS specifically, right? And I know we talked a little bit about, and there's been some questions going on amongst the panelists, like what's the difference between Class A, B, and C iOS and ISF facilities? And truly, right, it comes down to the functionality of the asset from a variety of perspectives. You could have a great service facility on the property, but it could be a triangle, right? So the property is a triangle. There's very little ways to actually use the yard. There's not great circulation, but again, it's got a great building on it. So you would think, okay, well, this should be a really nice facility. And again, vice versa, right? You might have this, this square yard, which is probably more valuable, right, with a terrible building on it than a great building that's on a triangular or irregular shaped yard. So I think when you're a buyer and you're explaining all of the intricacies to a lender, most are starting to understand it now, but you have to really go down to the bare bone basics of looking at it from the whole property perspective and what the existing rents are, or if it's vacant, what you think you can project, and not giving a breakdown of of building square footage, because when we're underwriting, there is no breakdown of building square footage. So I think that's one area where if you're a buyer and you're dealing with lenders, you all should obviously be using Justin anyways for all your lending resources and deal points, because he can help you through this process. But I also think, again, just when you talk about the evolution of financing within this space, that's an area where lenders have become much more comfortable understanding that the yard is critical and really a main driver in how you're going to come up with valuations for your space.
But also to that point, Dan, and like some of my favorite parts of working on the deals is actually going and touring the sites, either with the client or with the lender. You have, like in my seat, I have to see the site. If I don't see the site, how am I going to know if you can turn a 53-footer, off the highway into it? And we've done that with lenders before, where, you see on an aerial and they may say, well, you can't really turn a 53-footer. Well, we'll get on the phone with someone who owns one, or find somebody, go bring the lender out there on a Saturday or whatever day it is, and go tour it and go show them that's possible.
Justin has a commercial driver's license, so he can actually hop in the rig. And
Justin, what time is this start? Is done 2?
It's actually done in 5 minutes, and we've literally
Okay.
asked like 2 questions and
Yeah.
guys, and
So
this has been so awesome.
I think just a couple things, because I think right part of it was like, if you're new to iOS, what are you exploring, what are you looking for, and everything.
Yeah.
And I think you have some probably great knowledge here as well, and things to share over the next couple minutes. And obviously, Justin and Matt also. But to your point, Justin, this is really a touch and feel asset class. And when I say that, Justin, the fact that you're walking these properties and you're getting an understanding to help your clients is tremendous. We've heard horror stories, right, of groups buying sites, moving a tenant in, and the tenant shows up after moving their product in, and literally overnight, containers are dropping 2.5 feet into the yard under because of how wet and moist the yard is, right? And so they never looked at what a geotech report looks like. They have no idea what the compaction level is of their yard, and all of a sudden, a deal that they thought was going to be a great deal, that they're literally having to go redevelop for their their tenant, or the tenant's furious because they've got to go redevelop it themselves, and there goes your relationship with your tenant. So I think, again, understanding the dynamics of the iOS world, as if you're a buyer, you've got to check the box on environmental, right? So find a really smart environmental attorney and consultant who can give you an hour crash course in. You don't need to know what every chemical compound is, but you need to know the things that you should run away from, and that a lender is going to tell you you have to run away from unless you're buying in cash and you're going to do a cleanup. You have to have great zoning attorneys in any market that you are going to work in. And then, depending on the site, you probably want to engage some type of geotech to go and stick a boring in the ground, right? Yes, it's going to cost you some extra money, right? You might have to go do 5 or 6 borings on a 3-acre property, but you're going to know your level of compaction. And I can guarantee that when you go and market that property to a user, and you can show them a report that says, here's the strength of that yard, and you can put stacking containers X amount high, or putting utility piping down, or whatever the use may be, they're going to be blown away. Again, goes back to what I was saying about the zoning, that you took that extra step. So it may have cost you an extra $10,000 in third-party reports, but you're going to make that up with the relationship that you're going to cultivate with the user, with the market, with the broker, who is going to say, wow, I never even thought about doing that. You just got this deal because of what you were able to do. So I think, again, checking the box and having a DD report, right? A property conditions report is great, but I can tell you right now, right, that's going to check a box for a lender. If you need to replace a roof in iOS, it's not that big of a deal, because typically the building is sort of the least expensive item that you have. If you need to go tear up a whole yard, do new stormwater management, put in a bunch of new underground piping and runoff and the whole 9 yards, you're looking at millions of dollars, compared to I got to go replace the roof for $90,000.
I don't know how we're only going to do like 1 day of conferences next week. Like Nicole, we need like 3 weeks of this next next year. This has been
no kidding,
like,
you guys. This was so good. Like this was such a great.
Real
Go
quick,
ahead.
Ned and Dan, thank you so much for your honesty and just the way you guys talked about what you're doing, and some of the special sauce that I'm sure people are taking notes on, and we'll follow your lead. You guys are awesome. Like, thank you so much. That was really cool. And Matt, show us the mug real quick, please. There we go. One sec. There it is.
Yep, there you go.
Very nice.
Yeah.
Awesome. Thank you, guys. Thank you all so much for joining us on this webinar today. Thank you guys, our panelists, for, again, to reiterate what Justin said, for being so candid and open in what you were willing to share. That's huge. I mean, I know there can be a lot of protecting of that sort of information. So we really appreciate you just being so open and willing to share that. Otherwise, yeah. Can't wait for everybody to come out to Long Beach next week. And the registration link in the website is in the webinar chat right now, if you want to click on that. Otherwise, thank you guys so much for your time and for joining us. And we will see you soon.
Yeah, thanks, everybody.
Thank you, everyone.
Talk to you soon.
Thanks, everyone.